𝗕𝗢𝗡𝗏, a course in derivative securities, introduction to theory and computation.
Credit risk valuation, financial markets theory, equilibrium, efficiency and information, another credit risk book, risk neutral valuation, pricing derivatives, interest rate models, uncertainty vol models, financial markets in continuous time, visual explorations in finance, math of financial markets. This book is an outgrowth of notes compiled by the author while teaching courses for undergraduate and master's. Course in options and futures was considered an advanced elective, but now it's mandatory for any finance major and is an elective chosen by many non-finance majors. I wonder why. Moreover, students are exposed to derivatives in different courses. This expansion of education in derivatives mirrors the importance of derivatives in industry. MBAs focus on derivatives for hedging and speculating. That's sufficient. However, the seller of derivatives, in addition to needing to understand the buy side, is confronted with the need to price and hedge. The buyer, depending on the degree of competition, may likely benefit from some pricing knowledge as well. Pricing and hedging is the primary focus of the book. Therefore, learning the fundamentals of pricing and hedging, students also acquire a deeper understanding of contracts themselves. Hopefully this book will be of use to practitioners. The book is concerned with pricing and hedging derivatives in frictionless markets. So the book ignores transaction costs like commissions, bid-ask spreads, and the price impact of trades. It ignores margin and short selling restrictions. The theory of pricing and hedging in frictionless markets stems from Black-Scholes, Merton, and is a very well-developed theory. It is based on the assumption that there are no arbitrage opportunities in the market. The theory is the foundation for pricing in markets with frictions, but practice may differ from theory in important ways if the frictions are significant. For example, an arb opportunity in a frictionless market often will not be an arb opportunity for a trader who moves the market when he trades, faces collateral environments, etc., collateral requirements, etc. The book has nothing to say about how one should deviate from the benchmark frictionless theory when frictions are important. Another important omission from the book is jump processes. The book deals exclusively with binomial and Brownian motion models. The book is intended primarily to be used for advanced courses in derivative securities. It's self-contained. The first chapter presents the basic financial concepts. However, a lot of the material that is standard in an introductory book has not been included here. On the other hand, though it is not an introductory book, it is not a truly advanced book either. On the topics covered in the book, there are more advanced treatments available in book form already. However, most of those books are too narrow in focus for the courses I taught, or not easily accessible to students, or both. This book is a bridge for an introductory course and an advanced course. Towards that end, I've included citations to more books in appropriate places. This book is an introduction to computational methods, and the term introduction is meant quite seriously here. This book is for students with no experience in programming or numerical analysis, and it covers only the most basic ideas. Nevertheless, it is an extremely important feature of the book. It is my experience that the theory becomes much more accessible to students when they code or simulate a process. This book builds up binomial, Monte Carlo, and finite difference methods by first developing simple programs for simple computations. These serve two roles. They introduce the student to programming, and they result in tools that enable students to solve real problems, allowing the inclusion of exercises of a practical nature rather than just theoretical. It's a semester-long book. Nearly all the examples are derived from first principles, and they're in Excel VBA. They're downloadable free of charge on 𝗕𝗢𝗡𝗏.net, that's the author's name. They use a few special features of Excel, in particular the cumulative normal distribution and the random number generator. Otherwise, the programs are easily translated into any language, like MATLAB. We use exclusively the probabilistic martingale approach, both because it's my preference and because it seems easier than partial differential equations for students in business and the social sciences to grasp. Okay, we might need a different book. Sampling of some of the more or less distinctive characteristics of this book are important theoretical results are highlighted in boxes. The derivations that are less important are in smaller type. Changes of numeraire are introduced in the first chapter in a one-period binomial model. The probability measure corresponding to the underlying as numeraire being given as much emphasis as the risk-neutral measure. Fundamental result for pricing, as prices are martingales under changes of numeraire, is presented in the first chapter because it does not need the machinery of stochastic calculus. The basic ideas in pricing digital and shared digitals, and hence in deriving the Black-Scholes formula, are also presented in the first chapter. Digitals and share digitals are priced in Chapter 3 before puts and calls. Brownian motion is introduced. Talk about that. And Ito's formula, the distribution of the underlying under different numeraires is derived directly from the fundamental pricing result in Ito's formula, bypassing Gsirzanov's theorem, which is a consequence of Ito's formula. Substantial emphasis is placed on forwards, synthetic forwards, options on forwards, and hedging with forwards because there are many applications in fixed income and elsewhere. A simple example is valuing a European option on a stock paying a known cash dividend as a European option on a synthetic forward with the same maturity. Following this author, the formula for exchange options is derived by a change of numeraire from the Black-Scholes formula. Very simple arguments derive Black's formula from forward and futures options from Margrabe's formula, or Margrabe's formula, and Merton's formula for stock options in the absence of a constant risk-free rate from Black's formula. The demonstration of equivalence of these important models or formulas are as follows. Black-Scholes is equivalent to Black, Merton, Black-Scholes, and Margrabe's. Quanto forwards and options are priced by first finding the portfolio that replicates the value of the foreign security translated at a fixed exchange rate, and then viewing quanto forwards and options as standard forwards and options on the replicating portfolio. The market model is represented or presented as an introduction to pricing fixed income derivatives. Forward rates are shown to be martingales under the forward measure by virtue of there being forward prices of portfolios that pay spot rates. In order to illustrate how term structure models are used to price fixed income derivatives, the 𝗬𝗎𝗂𝐿 model is worked out in great detail. Other important term structure models are discussed much more briefly. Of course, none of these items are original, but in conjunction with computational tools, they make the rocket science of derivatives more accessible. We got 3 parts: introduction to options pricing, advanced option pricing, and fixed income. Most of the chapters build on each other. Okay, it's a course in derivatives. Introduction to option pricing, asset pricing basics, fundamental concepts, state prices in a one-period binomial model, probabilities and numeraires, asset prices with a continuum of states, introduction to option pricing in incomplete markets. Example, chapter 2 is continuous time models. This method is introduced in a binomial model and then extended to more general continuum of states models. Computations in the more general model require the continuous time mathematics that will be presented in chapter 2. We will begin with a brief description of the basic derivatives, calls and puts, and some other financial concepts. More detailed descriptions can be found in any of the introduction books on derivatives, 37 and 49. Maybe we should look at those. It should be noted that the pricing and hedging results in this book are not tied to any currency. For specificity and a consequence of our habit, we'll generally use dollars. Fundamental concepts, great. Longs, shorts, and margins. In financial markets, the owner of an asset is said to be long the asset. You are long Bitcoin. You are long Rigetti. If person A owes something to person B, the debt is an asset to person B, but a liability to person A. One also says that person A is short the asset. For example, if someone borrows money and invests the money in stocks, then the individual is short cash and long stocks. One must invest some of one's own money when borrowing money to buy stocks. For example, an individual could invest $600, borrow $400, and buy $1,000 of stock. The $600 is called the margin posted by the investor, and buying stocks in this way is called buying on margin. The investor or the portfolio is said to be levered because buying $1,000 of stocks with only a $600 investment amplifies the risk and return per dollar of investment. On a percentage basis, we would say that the account has 60% margin, the 60% being the ratio of equity, which is assets minus liabilities, which is $1,000 of stock minus $400 in debt, to the assets, which is $1,000 of stock. If the value of the stock drops sufficiently far, then it may become doubtful as to whether the investor can repay the $400. In this case, the investor must either sell the stock or invest more of his own funds. He receives a margin call. In other words, in actual markets, there are margin requirements that specify a minimum percentage margin an investor must have initially when borrowing the money and a minimum percentage that the investor must maintain. Rather than borrowing the money to buy stocks, an investor can do the opposite. He can borrow stocks to buy money. In this case, buying money means selling the borrowed stock for cash. Such an investor will be short stocks and long cash. This is called short selling, or more briefly, shorting stocks. For example, Suppose individual A buys 100 shares of stock, borrows 100 shares of stock from individual B, and then sells them to individual C. Both B and C are long 100 shares, and A is short. So the net long position is 200 minus 100. 2 times 100 minus 100, which is the original 100 shares that B was long. The short seller of stocks must pay to the lender of the stocks any dividends. In this example, both B and C own 100 shares, and they expect to receive the dividends. The company will only pay dividends to C, and A must pay the dividends to B. Of course, investors always wish to buy low and sell high. The usual method is to buy stocks and hope they rise. An investor who shorts also wishes to buy low and sell high, but reverses the order. He sells first and then hopes the stock will fall. The risk is that stocks will instead rise, which will increase the value of his liability, his short stock position, without increasing the value of his assets, which is a long cash position, thus putting him quote-unquote underwater. To shield the lender of the stocks from this risk, a short seller must also invest some of his own funds, and this amount is again called the investor's margin. For example, an investor might invest $600 and borrow and sell $1,000 of stock. In this case, the investor will be long $1,600 of cash, and he's short $1,000 worth of stock. So the equity is $600, and the percentage is calculated the same way, which is 60%. Again, there are typically both initial and maintenance margin requirements. An additional feature of short selling for small individual investors is that they typically will not earn interest on the proceeds of the short sale, the $1,000 of cash obtained from selling the stock. In this book, we will assume that there is a single risk-free rate at which one can both borrow and lend. Moreover, we will assume that investors earn this rate on margin deposits, including the proceeds of short sales, and including any margin that may be required when buying and selling forward and future contracts. Thus, investors gain from buying on margin if the asset return is sure to exceed the risk-free rate, and they gain from short selling if the return on the asset is sure to be below the risk-free rate. These assumptions are not reasonable for small investors, but they're fairly reasonable for institutions. We'll assume that no asset has a return that is certain to be above the risk-free rate, nor certain to be below the risk-free rate, because institutional investors would arbitrage those returns. Okay, calls and puts. Call and put options are the basic derivative securities and the building blocks of many others. A derivative security is a security the value of which depends on another security. Call option is the right to buy an asset at a pre-specified price. The pre-specified price is called the exercise price, the strike price, or simply the strike. We will often call the asset a stock, but there are options on many other types of assets also, and everything we say will be applicable to those as well. One caveat is that by asset, we mean something that can be stored. Thus, for example, electricity is practically speaking not an asset. The asset to which the call option pertains is called the underlying asset, or more briefly, the underlying. If the market value of the asset exceeds the exercise price, then we may say that the call option is in the money, or ITM if you see that abbreviation, that's what it means. Buying a call option is a way to bet on the upside of the underlying asset. A put option is the right to sell an asset at a pre-specified price, exercise or strike. Buying a put is a way to bet on the asset becoming low, or the asset price becoming low, similar to shorting. A put option is in the money if the exercise price exceeds the value of the asset. Both puts and calls are potentially valuable, and hence the buyer of a put or call must pay the seller. A long put option provides insurance to someone who is long the underlying asset because it guarantees that the asset can always be sold at the strike price of the put. Of course, it can also be sold at the market price if that price is higher than the strike of the put. Symmetrically, a long call option provides insurance to someone who is short the underlying asset. The terminology in option markets reflects the parallels between options and insurance contracts. In particular, the seller of an option is said to write the option, and the compensation price he receives from the buyer is called the option premium, just as an insurance company writes insurance contracts in exchange for premium income. Calculating the price at which one would be or should be willing to trade an option is the main topic of this book. It is important to recognize the different situations of someone who is short a call option and someone who is long a put. Both positions are bets on the downside of an asset, but both the investor who is short a call and the investor who is long a put may eventually sell the underlying asset and receive and receive the exchange price in exchange, or the exercise price in exchange. However, the investor who's long a put has an option to sell the asset at the exercise price. And the investor who is short a call has an obligation to sell the asset at the exercise price should the counterparty choose to exercise the call. Thus, the investor who is long a put will be selling at the exercise price when it is profitable to do so, whereas the investor who is short a call will be selling at the exercise price when it is unprofitable. The buyer of a put must pay the premium to the seller. He then profits if the asset price is low, with the maximum possible profit being quite large. The maximum value is attained when the market value of the underlying asset reaches zero. In contrast, the seller of a call receives premium income, and the premium is his maximum possible profit, whereas his potential losses are unbounded. Thus, these are very different positions. Individuals who sell calls usually sell out-of-the-money covered calls. Covered calls means that they own the underlying asset and can therefore deliver the underlying if the call is exercised without incurring any further expense. They experience only an opportunity cost in delivering it for less than the market price. In contrast, one who sells a call without owning the underlying is said to sell a naked call. The seller of a naked call, or the seller of a put, must post margin, just like a short seller of a stock, in order to ensure that he can meet his obligation. However, this does not apply to sellers of covered calls. A call being out of the money implies that the price of the underlying must rise before the call would be exercised against the seller. Thus, the seller of an out-of-the-money covered call still has some potential for profit from the underlying. In addition, of course, the seller receives the premium income from the call. Institutions often follow this strategy also, using the premium income to enhance their return from the underlying. One can hedge a short call without owning a full share of the underlying asset, if one is able to rebalance the hedge over time. Calculating such hedges is another principal topic of this book. In a certain sense, option markets are zero-sum games. The profit earned by one counterparty to an option transaction is a loss suffered by another. However, options can allow for an increase in the welfare of all investors by improving the allocation of risk. A producer who must purchase a certain input may buy a call option, giving him the right to buy the fixed input at a fixed price. This caps his expense. The seller of the call now bears the risk that the input price will be high. In this case, the option will be exercised and he'll be forced to sell at a price below the stock market price or the market price. It may be that the seller is in a better position to bear the risk. For example, he may have less of the risk in his portfolio. And the options transaction may thereby improve the allocation of his risks the allocation of risks across all investors. The similarity to insurance should be apparent. Quite complex bets or hedges can be created by combining options. For example, being long a call and a put with the same strike price is called a straddle. Such a portfolio is almost always in the money. It is in fact a bet on vol. A big move in the underlying asset price away from the exercise price will lead either to the call or the put having a high value. Another important example of an option portfolio is a collar. A collar consists of a long put and a short call, or a short call and a long put, with the options having the same maturity. As mentioned before, a long put provides insurance to somebody who is long the underlying asset. Selling a call provides income premium that can be used to offset the cost of the put. The most popular type of collar is a zero-cost collar, a collar in which the premium of the call is equal to the premium of the put. The cost of selling a call for an owner of the underlying is that it sells off the upside of the underlying asset. If the value of the asset exceeds the strike price of the call, then the call will be exercised and the underlying asset must be delivered for the strike price rather than the higher market price. Thus, one can purchase the downside insurance provided by a long put by selling part of the potential upside of the asset rather than paying the cost of the insurance out of pocket. There are many other examples of options portfolios that can be given. Some puts and calls are traded on exchanges. The exchange clearinghouse steps between the buyer and seller and becomes the counterparty for both the buyer and seller. So there's no risk the seller might default when the buyer chooses to exercise his option. If the owner of the option chooses to exercise, the clearinghouse will randomly choose someone who is short to fulfill the obligation. Isn't that great?
You might get randomly chosen. Probably not, though. All right. Most exchange-traded options are never exercised because any gain on a long contract can be captured just by selling the contract at the market price, canceling the position. So that's why you don't get randomly assigned when you trade options. However, the right to exercise is essential because it determines the market price. Puts and calls are also transacted over the counter. Very important concept on Wall Street. OTC. Which means that they are private contracts of the counterparties. Moreover, puts and calls are also embedded in many other financial instruments. A prosaic but important example is that homeowners have the right to pay off their mortgages early. That means they have call options on their mortgages, with the exercise price equal to the remaining mortgage principal. Similarly, callable bonds can be redeemed early by the company issuing them. Convertible bonds have embedded call options on the company's stock, which are exercised by converting the bonds, and many, many other examples. Puts and calls also exist outside of financial markets. For example, a company may begin manufacturing a new product at a small scale. If the product is successful, the scale can be expanded. In this case, the company buys a call option on large-scale production, but the premium is the cost of launching small-scale production. Adapting the methods developed for financial options to value such real options is an important growing field, and I want you to think about that. There are many times where you might say, well, I have a call option. One very untoward and uncouth example is some people used to say that if you ever dated a partner that was overweight, that you might have a call option on them losing weight, because if they lost weight, they'll be more beautiful, and you're getting a cheaper transaction cost. A little inappropriate, but that's the one way to look at the real world of calls and puts. Exercising policies for calls and puts is also important. It may be rational to exercise a call if the asset value exceeds the exercise price. Thus, denoting the price of the asset by S and the exercise price by K, the owner of a call option can profit by S minus K dollars by exercising the option when S is more than K. If S is less than K, exercise would be irrational. Thus, the payoff to the owner of the call option is max 0 S minus K, so the max of those two things. It has been said that timing is everything, and the timing here should be made. The simplest type of option is called a European option. A European option has a finite lifetime and can only be exercised at its maturity date. For a European call option, the exercise strategy just described is the optimal one, with S representing the asset price at the maturity date of the option. Equally, if not more important, are American options, which can be exercised at any time before maturity. For an American call option, the exercise strategy just described is the optimal one at the maturity date, but it may also be optimal to exercise prior to. Let K denote the exercise price, T the date the option matures, and S of T the price of the underlying asset at date T less than capital T. The intrinsic value of the call option at date T is defined to be the max of 0 and S of T minus K. One would, of course, never exercise unless the intrinsic value is positive. In other words, unless the option is in the money. Moreover, if the asset does not pay a dividend or other type of cash flow prior to the option maturity, then one should not exercise in any circumstances prior to the maturity. This is captured in the saying, calls are better alive than dead. Exercise being suboptimal is equivalent to the value of the option exceeding the intrinsic value. The principle that calls on non-dividend paying assets are better alive than dead follows from two facts. It is generally a good thing, in financial markets and in life, to keep one's options open. And early exercise implies early payment of the exercise price and hence foregone interest. The usual protest that is heard when the statement is made is that one should surely exercise if he expects the stock price to plummet, because by exercising and then selling the stock acquired, one can lock in the current price rather than waiting for it to fall, in which case the option will surely be worth less. This is very intuitive, but ignores the fact that you could short sell the stock if you expect it to plummet. You don't need to exercise the stock to lock in the current stock price. In fact, shorting the stock and retaining the option is always better than exercising, assuming the underlying asset doesn't pay a dividend. Specifically, suppose an investor considers exercising at date T. As an alternative to exercising early, consider shorting the stock at date T and retaining the option. This is always better than exercising at date T because the short position can be covered at cost K at date capital T by exercising the option, and paying K at date T is better than paying it at date lowercase t given that interest rates must be non-negative. So the position can be covered because the stock can be purchased and returned to the lender to cancel out the short position because of the call. To be more precise, note that the exercise at date lowercase t produces S of t minus k dollars at date t. On the other hand, retaining the option, shorting the stock at date t, and covering the short either by exercising the option or buying in the stock market, whatever is cheaper, produces S of t dollars at date t. And the maximum of 0 and S of t minus k minus S of t is equal to the maximum of negative S of t negative k, which is equal to the minimum, or the negative minimum, the negative of the minimum of S of t and k, which is greater to or equal than negative k dollars at date t. Hopefully you followed that. You might want to read the book and go through that once or twice, but it's very intuitive. If S of t is larger than k, one has negative k dollars at date t, in which case retaining the option has been superior due to the time value of money. Furthermore, if S of t is less than k, the strategy of retaining the option and shorting the stock produces negative S of t greater than negative k dollars at date t, so retaining the option is superior both due to the flexibility, which is waiting until t to decide whether to exercise turns out better than committing at date t before then, and because of the time value of money. We'll go into more detail in a second.